Want my latest market insights? My latest report, Trend Long AST Mobile Option Update plus 60,000%. Good enough is now available. Scan this QR code or click on the link in the description.
My rant is this. I'll share it. It's kind of on repeat. So this is our Slack client workspace. And basically this Look Mom 6955 is basically referring to that JP Morgan call that just got rolled on September 30th, yesterday. And it is interesting because a while back when I gave this update, SPX can easily move into 6,500 as long as this support holds. At the time, obviously, we were just getting above it. Otherwise, big picture, it can continue into 7,000, even 8,200 in time. Now, that was back in early July. So the point is overbought can stay overbought. And sure enough, this little line here, you can't see it very well, but it says 69.50. That's a fib level you throw on. And wouldn't you know, JP Morgan comes in with their spread, and it is the $69.55 call. So they have moved up and they are selling the call against a large put spread into end of year. And it's just interesting that it happens to be the same fib level. So 69.50, 69.55, same difference. Look, Mom. Now, the rant that I keep having live in my trading room is basically the same, which is it's on repeat. The market keeps moving higher. It's on repeat. Corporate buyback, blackout, we know about. It's about 95%, give or take, depending on who you're following, right straight through until the October 24th. CTAs, which we've talked about repeatedly, still have not sold. Why? Because they don't have a reason to. We need a macro trigger. And believe it or not, government shutdown risk is absolutely a trigger, but only if it lasts more than a week. And in the meantime, I keep saying breadth is starting to soften, but it hasn't rolled over. You don't short all-time highs, you don't buy all-time lows, but the point is liquidity is still solid. And as long as there is buying, it is something that's very hard to get in front of and sell. I also have the growth value ratio that we look at every time we do this because it's very telling. We're still in a growth rotation. Is it forming a pattern of reversal? It's getting closer for sure. US yields, dollar, oil, they're all chopping sideways. And what I call sideways, people get very zoomed in on a very short duration, but big picture, we are still in this kind of 65 handle for crude. Dollar is sitting on 98. 10-year yield is above 4%. We got really a Goldilocks kind of equity zone between 4 and 4.5%. Anything below starts to get a little iffy. Anything above will definitely get a lot more iffy. And then, of course, the narrative. You were talking about sentiment indicators. The bull market rationalizing of bubble-like valuations. I write about that a lot, but it's not a reason to short. And then last but not least, we have definitely seen Volmageddon hedges, and I wrote about this. They're rolling in for year end. They're positioned in March, and they are definitely lower. So that's one thing. And gold skew is just clearly in play, macro risks down the road. So that's it. In general, I just keep kind of pushing on this theme that we're still moving up. And in fact, 67.13 is a level that I gave yesterday. It's now 68.05. So we have a situation where everyone is kind of exhausted by the bull run. I don't think it's hated. It's just, it's got no reason right now. Even with our bifurcated K-shaped economy, which I have also written about that a lot, which is we've got a situation, no question. And I know you and I have talked about this, but this is a very different backdrop now. Consumer lending sector started rolling over last week when the ABS, the lending Tricolor and First brands went belly up last week and again just a few days ago. And then basically this is really creating some initial tremors in the credit markets. So I would contend falling credit quality trumps falling credit spreads. Everyone's looking at the tightness of credit spreads, but we absolutely have a situation where this is affecting the lower to middle income consumers from real personal consumption growth. It's expected to decelerate. We've got households. Anyway, I put a whole bunch of data in here, and Jeffrey has been on this very, very front and center as it relates to the weakening situation. BIS, for those who actually follow big macro tells of BIS, has been warning. Fitch also came out just yesterday and started warning. So the whole ecosystem yesterday was kind of upset on the First brand's bankruptcy, but it also hit regional banks. And and major banks even started to soften. So Fitch came out with a warning, interestingly enough, about the private credit market, which is small, relatively speaking, but it can be kind of the first pressure that then causes credit spreads to widen and then the hedge funds to unwind their U.S. Treasury shorts and their Mag 7, Mag 10 long. That is a pair trade where they're extremely short bonds and then very, very long the VIP stocks. And so when they start to unwind that, you start to get higher yields. And then, of course, the higher yields lead to higher cost of financing, higher term premia, and then you start to get volatility finally. Right now, we do not have FX currency volatility. We don't have treasury volatility. We don't have equity volatility. When you get a fundamental or a macro trigger, like war breaking out is also a gray or worse swan. But the point is, then you have a reason for volatility. But the weakening of what's happening in the market underneath is still a tell that the consumer is definitely not as well as on Main Street as Wall Street. So we have some massive, just to kind of end the rant, we have some massive concentration risk that is making this bull train chug along on the track, and it takes a few miles because it's fully loaded, right? You can't just stop a train on a dime. It takes miles for it to come to a stop. In the meantime, we haven't stopped. We're still going up. But kind of consider this. The top 10 holdings in the S&P make up 39% of the index, the highest concentration on record, and the world's 7 largest companies are all U.S. tech giants, which is why folks are passive income still goes that way. But as unemployment starts to pick up, and it is, and it will continue to pick up, this will hit the passive investing. This will hit margin debt. This will hit disposable income. This will hit selling, believe it or not, of equities. And long story short, we've got 22 of the top 25 companies in the world are American. So long story short, we definitely have volatility that's coming in, but we have timing it is the tough part. And I will continue to kind of bang on this drum that we have moved into this inflationary world that isn't being priced in, monetary inflation. And even Michael Howell was out this week saying large-scale monetary inflation is underway as a result of fiscal dominance, something I keep talking about. Investors face a future of world of monetary inflation, not financial repression. And financial repression is what we're really excited about on Wall Street. Keep and suppress rate volatility, equity volatility, and currency volatility. And so when that starts to change, and we need a reason for it, is when we start to have equities repriced. And right now we do not have, we got the tipping point, but we don't have the employment or the inflation data to cause it to roll over. So that's it. That was the explanation that I'm giving as it relates to the difference between the Wall Street, let's trade whatever's moving. And there's so much going on. It's awesome. From metals, not just related to data centers, but also themes like AI software, all the way through to the debasement and devaluation of the dollar keeps also the market looking a lot healthier. But honestly, it's still just monetary inflation. It's unfortunately not really a great backdrop for a sustainable economic growth advance. So we'll see what happens. We'll see, obviously, as we get into Q4, what looks better, what looks worse. But right now, there's no question we still have concentration risk, and that's driving the show.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.